The next global financial crisis won't start with a stock market bubble or a housing crash. It is already starting inside the uninsurable servers of AI data centers and the physically destroyed pipelines of the Persian Gulf.
Yeah, I mean, it's a profound collision between our limitless digital ambitions and a very brutal, just unyielding physical reality.
Right, so today, we're exposing a massive distortion in how the entire world thinks about risk. If you are listening to this, you need to know why the traditional financial models your bank relies on, the ones projecting steady growth and endless liquidity, are completely blind to the physical constraints that are actively rewriting the global economy right now.
Exactly, because we're looking at a system that has essentially priced in absolute perfection while completely ignoring the undeniable fragility of its own foundations.
Yeah. Our mission today is a deep dive into the underlying systemic threats that just aren't making the front pages. We are going to connect the dots between global energy shocks, the hidden rot in shadow banking, and the surprising and honestly incredibly physical limits of artificial intelligence.
It's all connected.
It is. And by the end of this conversation, you are going to have a completely new framework for understanding every single piece of economic news you hear. Okay, let's unpack this, starting with the literal engine of the global economy, energy.
Right, and right now, that engine is taking direct catastrophic hits that the market hasn't fully digested yet.
Yeah, let's talk about the geography of tension here. Because, when you hear about conflict in the Persian Gulf, your mind probably goes straight to political posturing.
Yes, standard geopolitical noise.
Exactly. You think of embargoes, OPEC quotas, or maybe a temporary blockade where diplomats eventually sit at a table, sign a paper, and the oil flows again. But the data we are looking at outlines a situation that has escalated way past politics into pure physical destruction.
It's a completely different scale.
It really is. We are tracking documented military strikes on Iran's South Pars field and severe retaliatory attacks on Saudi, Emirati, and Qatari infrastructure. They even hit the Ras Al Afan hub.
Which is, that is an absolute crown jewel of global liquid natural gas processing. It's not just a pipe in the ground. It's a massive, highly specialized industrial complex.
Right. And the result is the effective closure of the Strait of Hormuz. We are talking about isolating the transit of 21 million barrels of oil per day.
Which is staggering.
It is roughly 20% of the entire world's oil trade, just instantly paralyzed. It creates an unresolvable deficit of 10 million barrels per day. Brent crude has already breached $110 a barrel. But wait, let me push back on how this is usually reported.
Sure.
My first instinct, and I think the instinct of most investors listening, is that this is just a severe geopolitical timeout. Like someone steps in, negotiates a peace deal, and we literally turn the tap back on next week.
And that is the crucial distinction, and it's exactly where the standard financial models fail. Because when you destroy extraction and refining capacity, you are no longer dealing with a political timeline. You are dealing with an engineering timeline. You cannot legislate a destroyed petrochemical plant back into existence. To rebuild a facility like Ras Al Afan, you need specialized metallurgy, custom compressors, highly skilled engineering teams.
Because it's not a water faucet. It's an incredibly delicate, high-pressure system.
Exactly. You are talking about multi-year lead times just for the parts alone. And what we are witnessing here is a deliberate strategy of geographic choke point asymmetry.
Choke point asymmetry. So basically weaponizing the actual map itself.
It is exactly that. It allows state actors like Iran or even China to inflict maximum economic pain on the global system while absorbing minimal direct costs themselves.
Wow.
Yeah, by targeting these specific irreplaceable logistical bottlenecks like the Strait of Hormuz, they convert a localized physical strike into a massive global tax on production. We are already seeing the downstream effects of this. The chemical giant BASF just announced they are raising prices by up to 30%.
Wait, 30%. Let me play devil's advocate here for a second. If base chemicals cost 30% more, wouldn't manufacturers just stop buying them? Wouldn't demand plummet, forcing BASF to lower those prices back down to reality? Just basic supply and demand.
Normally, yes, if we were talking about discretionary goods, like if TVs get too expensive, you just don't buy a TV. But we are talking about base layer chemicals here.
Right, the stuff you need to make everything else.
Exactly. These are the foundational ingredients for agriculture, fertilizers, pharmaceuticals, packaging. Demand for these inputs is highly inelastic. You can't just, decide not to fertilize crops or package food.
Yeah, makes sense.
So the manufacturers have to eat that cost, and then they pass it directly on to you, the consumer.
Which brings us to a massive logic turn in how our economy functions right now. Let's look at the central banks. The Federal Reserve in the U.S. is holding interest rates around 3.5 to 3.75%, even as their primary inflation gauge core PCE sits at 3.1%. In Australia, the Reserve Bank is holding at a highly restrictive 4.1%.
They are trapped. It is a textbook stagflation trap where inflation is high, but economic growth is stalling. But we are seeing it on a scale we haven't seen in decades.
Well, let me make sure I fully understand the trap here. Normally, if the job market starts cooling down, a central bank would lower interest rates to make borrowing cheaper, which then stimulates businesses to grow and hire, right?
That is their standard playbook, yeah.
Yeah.
But you cannot print physical oil.
Hmm.
Central banks have immense power over demand. They can make it cheaper or more expensive for a business to take out a loan, but their toolkits are fundamentally powerless against an exogenous supply shock.
Meaning a supply shock that comes from entirely outside the financial system, like a pipeline blowing up so the oil literally does not exist.
Precisely. If inflation is being driven by the sheer physical lack of raw materials, cutting interest rates won't magically create more oil or build new chemical plants. It will just mean more cheap money chasing a shrinking pool of physical goods.
Which just sends inflation into hyperdrive.
Exactly. So the central banks are forced to keep interest rates painfully high to crush consumer demand until it matches the broken supply chain.
But keeping the cost of borrowing at peak levels, right when corporate revenues are falling because energy costs are through the roof, I mean, that sounds like a recipe for a hard landing. We are staring down the barrel of massive corporate defaults, especially for companies that survived the last decade, strictly by refinancing super cheap debt.
Oh, absolutely. And because those central banks are trapped holding rates high, the pressure is moving into the shadows. The traditional banking system is squeezing, so the hidden corners of the financial system are beginning to crack under the strain.
Which brings us to a huge hidden risk. Because capital is so expensive right now, risk is migrating. Let's talk about the illusion of liquidity in shadow banking, or what the institutions politely call non-bank financial institutions.
Right, NDFIs. This is where the structural rot really starts to show.
Let me set the scene here for you listening. We are looking at a specific trigger in the private credit market. There is a major investment fund called Stone Ridge Asset Management. They specialize in consumer and corporate loans for the fintech sector, so companies like Affirm and Block. And Stone Ridge just restricted investor withdrawals. They initiated a gating mechanism.
Right.
Out of all the investors who panicked and asked for their money back, Stone Ridge only fulfilled 11% of those requests.
11%. I mean, imagine going to an ATM asking for $100 of your own money, and the machine gives you $11, locks your account, and tells you to go home.
It sounds like a roach motel for capital. Investors see inflation rising, they see geopolitical risk, and they want their cash out. But the money checked in, and it can't check out. It is completely trapped in these illiquid, long-term loans. But why couldn't the fund just sell the loans to someone else and give the investors their cash?
Because that exposes the great lie of the shadow banking sector over the last decade. During an era of zero interest rates, capital desperately chased yield. Investors poured money into private credit because it offered way higher returns than traditional bonds.
Right. The numbers looked great on paper.
Yeah, but these funds used internal, highly subjective mark-to-model accounting to pretend these loans were stable and liquid. They essentially graded their own homework. But you can't satisfy a panicked investor's redemption request with a mathematical model. You need real, hard cash.
And to get that cash today, they would have to sell those fintech loans into a market that knows they are desperate, meaning they'd take a massive, massive loss.
Exactly.
But here is the contagion risk, and this is what should really wake people up. This isn't just a few wealthy private equity investors losing out. U.S. commercial banks, like the everyday banks, have extended $1.2 trillion in loans to these non-bank financial institutions. And that staggering risk is heavily concentrated in just the top 25 banks.
What's fascinating here is how the regulatory bodies in Europe are responding to this buildup of toxic risk. You would assume they'd be cracking down, demanding that banks hold more capital in reserve to cover potential defaults.
You would think so, yeah.
But instead, they are actively hiding it.
The regulatory arbitrage happening right now is wild. The European Commission is deliberately delaying the implementation of major market risk standards, specifically a rule called the Fundamental Review of the Trading Book. They are pushing it all the way back to January 2027,
And they are doing this to protect European investment banks from a projected 50% increase in capital requirements. They know their banks simply cannot survive that kind of regulatory scrutiny right now. It would freeze lending entirely.
Wow.
So the regulators are legally allowing them to operate with a remarkably thin safety net.
But it gets worse. While the regulators delay the rules, there's been a 5 times growth in something called synthetic risk transfers, or SRTs, since 2016. Let me see if I can explain this mechanically because it sounds incredibly shady.
Let's hear it.
Okay, an SRT. Is it basically like a teenager paying their older, reckless friend to hold their fake ID while the bouncer walks by? Like, the bank has a portfolio of terrible, risky loans. Instead of holding cash in reserve to cover those loans, the bank pays a fee to a shadow bank, like a hedge fund, to theoretically take on the risk. The risk didn't disappear, it just stepped out of the regulatory spotlight. Did I get that right?
That is a remarkably accurate analogy, actually. The commercial bank pays a premium to the unregulated hedge fund to essentially insure the toxic tranche of their loan portfolio. Legally, the risk is shuffled off the regulated bank's books.
So they look perfectly fine.
They look incredibly safe on paper to the regulators,
No.
but the risk was just handed to an opaque, completely unregulated shadow entity.
So the entire system is sitting on a powder keg of invisible toxicity. If a market stress event hits, like an energy shock, and those shadow banks take massive losses and can't cover the insurance they promised,
Then the risk boomerangs right back to the commercial banks. The hedge funds default on their obligations. The commercial banks suddenly realize they are holding billions in unhedged, toxic debt, and it causes an uncontrollable liquidity shock.
unbelievable. So if traditional finance is playing this high-stakes game of hot potato with toxic debt, and the physical world of energy is blowing up, where is the smart money hiding?
Well, it's fleeing the physical world entirely.
Right. The market has convinced itself that the only safe harbor is artificial intelligence. It's the ultimate digital escape. AI is software, it scales infinitely, it doesn't need ships to cross the Strait of Hormuz. But our analysis shows that AI is about to violently crash into physical reality.
This is the hardware limit. We treat AI as if it exists purely in the ether, as weightless software. But the cloud is very heavy. It is made of copper, steel, concrete, and a terrifying amount of electricity.
Let's look at the power grid limit. The AI data center boom is expected to draw $6.7 trillion in investment by 2030. Everyone is racing to build massive server farms to train these large language models. But the physical nature of these server racks has mutated. A few years ago, a standard cloud server rack consumed about 5 to 10 kilowatts of power. Today, a single AI server rack pulls 50 to 100 kilowatts. Why the massive jump?
It comes down to how the computing actually works. Traditional cloud servers run on CPUs, handling tasks sequentially, like hosting a basic website. But training an AI requires thousands of GPUs, graphics processing units, firing simultaneously to process massive matrix equations.
Right, which takes way more juice.
That parallel processing requires immense electricity, and more importantly, it generates insane amounts of heat.
Hence, the massive liquid cooling systems and the staggering power draw. To put that 100 kilowatts in perspective, the Texas electrical grid ERCAN is projecting a 22 gigawatt spike in demand by 2031 just from these data centers.
A single 100 kilowatt rack is drawing the equivalent power of a small residential neighborhood condensed into a metal box the size of a refrigerator.
That is terrifying.
Yeah, and the existing physical electrical grid simply cannot support this density. You cannot just plug that into a local substation. There are multi-year waiting lists just to get approval to connect to the grid.
So what do these multi-trillion-dollar tech companies do? They aren't going to wait 3 years for a permit.
They are being forced to go off-grid. They are literally mass purchasing industrial natural gas turbines to generate their own electricity on site. The most advanced software companies in the world are being forced to become unregulated fossil fuel utility companies just to keep their servers humming.
Which is incredibly expensive, completely undermines their carbon-neutral pledges, and ties them right back to the physical natural gas markets we were just talking about.
It's it.
But here's where it gets really interesting. Even if you have the billions to build it and the gas turbines to power it, you might not be able to insure it. The data highlights a massive insurance paradox. The global insurance industry is looking at these AI megaprojects and flat out refusing to cover them.
And if you understand classical project finance, without insurance, the entire architecture of construction collapses.
The specific example we found is just staggering. Meta is trying to build a $30 billion data center campus in Louisiana. $30 billion. but they were only able to secure $4 billion in insurance coverage from the market. The insurers basically looked at it and said, we will not cover the other $26 billion. Why would the insurance syndicates walk away from those massive premiums?
Because insurers operate on strict mathematical models, primarily something called maximum foreseeable loss. When you concentrate $30 billion of highly sensitive hardware in a single geographic location,
Especially a location historically prone to hurricanes like Louisiana.
exactly, you are creating a catastrophic concentration of risk. If a Category 5 hurricane hits, or a localized grid failure causes the cooling systems to fail and melts down billions in GPUs, the payout would literally bankrupt the reinsurance syndicate.
Wow.
The math breaks. So they simply refuse to put that much risk on their books.
Wait, so if Meta can only get $4 billion in insurance on a $30 billion project, they can't go to a bank for a construction loan. No commercial bank will lend you $26 billion for an uninsured building.
Exactly. This breaks the traditional capital expenditure model. It forces big tech companies to fund these massive projects entirely off their own balance sheets with cash.
That's insane.
They have to swallow all the catastrophic risk themselves. This isn't just a minor bureaucratic delay. This dynamic is setting up a massive 18 to 24-month freeze in global AI infrastructure deployment. The financial mechanisms to build it simply do not exist.
So we have limitless digital ambitions, slamming face first into the physical limits of the power grid, the natural gas supply chain, and the risk tolerance of the insurance industry. And this brutal clash is completely flipping the job market for everyday people. Let's move to a phenomenon we're calling the Great Labor Inversion.
This is where the macroeconomic shifts leave the theoretical realm and hit the individual listener right in their wallet.
Right, because for decades, the societal narrative was clear.
Right.
Automation and robotics would replace blue-collar physical labor first. We thought factory workers and drivers were at risk, while cognitive white-collar desk jobs were safe. But the data shows the exact opposite is happening. Up to 74.5% of cognitive tasks, the daily work of programmers, financial analysts, QA testers, copywriters, are now highly vulnerable to automation.
It's a massive shift.
It is. We are already seeing massive tech companies like Atlassian and Block actively firing thousands of white-collar workers, and they are masking these mass layoffs under the corporate guise of AI implementation and cost optimization.
It is an aggressive, structural devaluation of cognitive capital. Corporate incentives right now are entirely aligned with replacing high-salary, screen-based workers with generative AI models that don't need health insurance or, stock options.
But contrast that digital bloodbath with the physical world. While tech workers are updating their resumes, there is a severe, almost desperate labor shortage in physical construction, heavy engineering, and logistics.
If we connect this to the bigger picture, who is going to physically pour the concrete for those $30 billion off-grid AI data centers? Who's going to weld the natural gas turbines? Who is going out into the Persian Gulf to physically rebuild the specialized petrochemical pipelines?
That certainly isn't a language model.
No, it's not.
The raw numbers show that trade unions like the CFMEU in Australia, the Construction and Maritime Union, are realizing they suddenly have a monopoly on the only labor that actually matters right now. They are dictating terms, demanding massive wage premiums, and threatening to halt critical infrastructure projects entirely if their demands aren't met.
For the first time in modern economic history, a technological shift is destroying high-paying cognitive jobs faster than it is destroying manual ones. And this creates a devastating structural squeeze on the broader economy.
Let's walk through the mechanics of that squeeze, because it affects everyone.
Think about the foundation of the middle class. Those white-collar, laptop-class workers are the primary drivers of retail consumption. They are the ones taking out mortgages for suburban homes, buying premium consumer goods, paying for wealth management services.
Right.
When you degrade their earning power through AI automation, you severely degrade the core engine of consumer demand. But at the exact same time, because physical labor is in such a severe shortage, the cost of building anything in the real-world infrastructure, housing, energy grids is skyrocketing.
It's a dual crisis that feeds on itself. The people who historically buy things have less disposable income, and the physical structures we desperately need to keep society running cost exponentially more to build.
Exactly. It is long-term, structurally embedded cost inflation running parallel to consumer demand destruction.
So what does this all mean? We are looking at a fundamental shift in perception. If you step back and look at the destroyed pipelines, the trapped shadow capital, the uninsurable servers, and the labor inversion altogether, it becomes incredibly clear that the old economic model is dead.
Completely dead.
For the last 20 years, we relied on endless digital scaling. We believed software would eat the world, and if anything ever went wrong, central banks could just lower rates and print more money to paper over the crisis.
That era is definitively over. The new reality is brutally dictated by unyielding physical constraints.
You cannot print unrefined oil when a pipeline is blown up. You cannot print electrical grid capacity when a data center needs the power of an entire city. And you cannot digitally code insurance coverage for a $30 billion facility sitting in a hurricane zone. The old rules no longer apply.
They really don't.
We've laid out the pressure points today, but there are massive, unresolved nodes that we are going to have to track in the coming weeks. For example, what happens when that hidden $1.2 trillion in shadow banking loans starts failing at the smaller regional bank level? I mean, the banks completely outside the safety net of the too-big-to-fail top 25.
We don't know the exact exposure of those regional banks because it is a deliberate regulatory black box.
Right. And what about the geopolitical fragmentation? With the U.S. formally requesting $200 billion for war funding across multiple theaters and major diplomatic summits, with China being indefinitely delayed, what happens when geopolitical decoupling fully shatters our global supply chains? What happens when the nations holding these physical choke points start demanding payment for raw materials and currencies other than the U.S. dollar?
The structural integrity of the global financial system is being tested in ways it was never architected to withstand, which leaves you with a critical, entirely new question to evaluate in your own life and your own community.
Think about the city or town you live in right now. For decades, local tax bases have been funded by downtown commercial real estate, filled with white-collar workers paying local taxes, eating at local restaurants. If those cognitive jobs are automated away and all the new wealth flows strictly to remote industrial hubs, massive off-grid data centers, and foreign physical supply chains, how does your local community survive when the digital wealth it relied on simply evaporates?
Look at your own career, your own investments, and your own skills. Are you betting your future on the illusion of infinite digital expansion, or are you anchored in the brutal physical reality of the new economy?